We are beginning our coverage with the liquidity push that has come in from the Reserve Bank of India. India, of course, continues to be on lockdown. The Reserve Bank of India announced a slew of measures to boost the economy. The RBI Governor Shaktikanta addressed a presser wherein he announced a 4-step battle plan to fight coronavirus. The measures included ensuring of liquidity in the markets, ensuring that the bank credit loans are sustained, relaxing repayment pressures and minimizing the market volatility. In a major relief coming into the borrowers, the RBI governor also announced a 3-month stay on installment and loan interest payments. Prime Minister Narendra Modi has hailed the RBI governor, tweeting that the announcements will be beneficial to the middle class and businessmen.
All commercial banks, including regional rural banks, small finance banks and local area banks, cooperative banks, all India financial institutions and NBFCs, including housing finance companies and microfinance institutions, that is all lending institutions basically in the system, are being permitted to allow a 3-month moratorium. I repeat, all the lending institutions are being permitted to allow a moratorium of 3 months on payment of installments in respect of all term loans outstanding as on 1st March 2020. Regulatory policies can broadly be delineated under 4 categories. First, measures to expand liquidity in the system sizably to ensure that financial markets and institutions are able to function normally in the face of COVID-related dislocations. 2, steps to reinforce monetary transmission so that bank credit flows on easier terms are sustained to all those who have been affected by the pandemic. 3, efforts to ease financial stress caused by COVID-19 disruptions by relaxing repayment pressures and improving access to working capital. And 4, endeavor to improve the functioning of markets in view of the high volatility experienced with the onset and spread of the pandemic. After extensive discussions, the MPC voted for a sizable reduction in the policy repo rate and for maintaining the accommodative stance of monetary policy as long as necessary to revive growth, mitigate the impact of COVID-19 while ensuring that inflation remains within the target. While there were some differences in the quantum of reduction, the MPC voted by a 4-2 majority, that is by a 4:2 majority, to reduce the policy repo rate by 75 basis points to 4.4%.
This is the way to go. It's a very progressive and timely measure, and I really compliment the Governor RBI on putting this moratorium of 3 months and also waiving off the interest and bringing down the repo rate, and this will go a long way. This was a much needed progressive measure.
Rajiv Dubey, editor Business Today, now joins us live for the very latest on this. Rajiv, if you could break this down for our viewers as well. 3 big points stand out. One is, of course, on the 3-month moratorium on interest payments allowed to banks for the lenders. The other thing is the repo rate cut of 75 basis points or 0.75% that is coming in, and a reverse repo rate cut of 90 basis points or 0.9, almost about 1% coming in right there. And what this really means for the overall economy in terms of a liquidity push.
See, of the major measures, I think moratorium is the biggest, and that is something that was really needed by the industry. Essentially, what it does is that it defers your installment payment by 3 months. So you do not pay principal, you do not pay interest for about 3 months. Although if it's a 36-month tenor, the tenor stays the same. It's just that it becomes 39 months, and you do not pay anything for these 3 months. Now, the only confusion that this has come out with is that the statement clearly says the banks have been permitted to allow. Now, this is not the kind of terminology that RBI typically uses. RBI normally orders the banks to do things, and financial institutions and the entire financial services sector follows those orders. In this case, it has been permitted to allow. It actually leaves it in the hands of the banks to decide what kind of loans will be allowed, what will not be allowed, what kind of borrowers will be benefiting from this, who will not be benefiting, whether your home loans will be allowed and car loans will not be allowed. Those are the kind of permutations and combinations that will now be thrown up, and every borrower will then have to go back to their banks and ask them whether their loan qualifies for this or not. So that's the window of confusion that will prevail for a long time after this order. But much needed, demanded by the industry, agreed to by RBI, but leaves a lot of confusion. The other big thing that it has done, Reserve Bank has done, is that it has thrown enormous amount of liquidity into the system. 3.74 lakh crore of liquidity in one go is unprecedented. Basically, what this does is that when the businesses need them the most, as soon as the 21-day window expires and lockdown is removed, when businesses come back into action and they need money to restart their businesses, to restart their operations, they will be needing this kind of money. And for RBI to clear this, to approve this right away is a very creditable move, because it gives that time to the businesses to tie up their finances and hit the ground running on the 22nd day. Now, tied to that liquidity is the interest rate cuts. So those two combined together are very good moves, because 0.75 cut in interest rates, 0.75% cut in interest rate, if it is transmitted as soon as it can be, it should ideally be transmitted very soon. And the very fact that about 0.5 or 0.6% of interest transmission had still not happened. Now, if the total transmission amounts to 1.3, 1.4%, that's enormous for every kind of businesses and every kind of individual in the country. And it will be a huge booster.
Absolutely. We'll also have to see, Rajiv, whether the banks end up passing this repo rate cut to the end consumer or not. That's going to be one very important thing to look out for, because that is going to be deciding whether the kind of liquidity push that the RBI is trying to give is actually palpable on ground and the economy gets the much needed respite. And as you said, unprecedented liquidity infusion, but we're living in unprecedented times as well at the moment.